You've probably heard terms like index funds, mutual funds, hedge funds, and ETFs many times. Today, I'm going to break them down in the simplest way possible so you truly understand how they work. We'll cover what a fund is, the different types, how they operate, the risks, fees, strategies, and who each type is really meant for. Give me just 10 minutes, and you'll learn what most people take years to figure out. Before we start, remember, this video is only for educational purposes, not financial advice. Imagine you and your friends are planning a big party. Instead of one person paying for everything, everyone contributes a small amount. When the money is pooled together, you can buy food, drinks, decorations, cake, everything needed without stressing any single person. A fund works exactly like that. People put their money together, and that combined amount is used to invest in things like stocks, bonds, real estate, or other assets. The fund handles the buying and selling for you, and everyone shares the overall results. Give me just 10 minutes, and you'll learn what most people take years to figure out. Before we start, remember, this video is only for educational purposes, not financial advice. Now that you know what a fund is, let's look at the types, starting with index funds. Index funds are extremely popular online because they're simple and low cost. You may have heard people say, just invest in an index fund and relax. But what does that mean? An index fund doesn't try to choose winning stocks. Instead, it copies a list called an index, basically a sample of the market. For example, S&P 500 tracks 500 large U.S. companies. NASDAQ focuses on tech companies like Apple, Amazon, Microsoft. Dow Jones tracks 30 major established companies. Index funds don't guess or pick stocks, they follow the index. This is called passive management, and it keeps expenses very low. Typical annual fees are around 0.02% to 0.20%. They're also less risky relatively, because your money is spread across many companies. Index funds don't trade all day like stocks or ETFs. They are priced once per day after the market closes. This price is called the net asset value, NAV. If you buy at noon, your order will be processed at the NAV calculated after the market closes. Mutual funds look similar to index funds, but they're usually actively managed. A professional manager or team tries to pick the best investments to beat the market. This sounds great, but fees are higher, 0.5%, 1.5% plus. Most active funds fail to beat the market consistently. People choose mutual funds when they want a specific strategy or access to investments not available through index funds. Like index funds, mutual funds are also priced once per day at the end of the market session. Hedge funds are completely different from index or mutual funds. They're private investment funds that use advanced and aggressive strategies. They may use short selling, borrowed money leverage, derivatives, complex trading methods. The goal is high returns, but the risk is also very high. Hedge funds are usually available only to wealthy investors. They charge huge fees, 2% management plus 20% of profits, the famous 2 and 20 model. ETFs are like a mix of index funds and individual stocks. Like index funds, they offer diversification, but like stocks, they trade all day on the stock market. This means you can buy, sell anytime during market hours. Prices change throughout the day. Many ETFs have very low fees. They often follow an index, passively managed. They are accessible, flexible, and great for beginners and long-term investors. For most regular investors, index funds or ETFs are the best long-term choices. Mutual funds might fit certain goals but come with higher fees. Hedge funds are for high-net-worth individuals who can handle big risks. If you found this helpful, don't forget to like and subscribe. Thanks for watching. See you in the next video.